Good day all. Ira Epstein of Linn Associates with your agriculture update for this Monday, the 18th of March, 2019. And here we are approaching, 3:45 in the afternoon, getting up to that time frame. And as you can see, a down day in the grains. Now, you probably wouldn't think that if you were watching your news over the weekend as they were talking the massive flooding and how farmers are going to be delayed from getting their crops in, their cotton in, and all the other markets. The problem with that, and it is true, is the demand for our crops is still not there. We still don't have a Chinese deal, and that's problematic. You wouldn't know that if you look at the hog markets, which have soared 6 days in a row off of the hope that we're going to do more exports to Asia, possibly to China. But the rest of the grains, no, you're not seeing that at this point. When we come in and we look at a weekly area chart, notice how you're starting to fight at this weekly zone here at the 903 area. You close today 905 3/4, the low 901 3/4. And this is obviously a weekly area chart of closes, so I can tell you what the week's high and low is, but that's about all I can do right now. But that's about where you're at. When we take a look at the daily chart, I'm still stuck with this pattern of looking, just as you are, at the market tries to rally, doesn't get through these big previous highs. When you come in on the swing line study, you've got a higher high and a lower low, which is not a trend. A trend, as I define it at least, in a downtrend would be lower highs, lower lows. You can get that as early as tomorrow by not taking out today's high. That's all that's necessary. And then the swing line would have this as a peak. So that's what I'll be looking to see what it does. Where's the battleground for this market? This is the 18-day moving average of closes. 908 3/4, 909, market settled right under it, 905 3/4. So the battleground is being defined. We saw the support coming in at lower Bollinger Bands on numerous times. I have no reason to think if it didn't go down there again, if it did, that wouldn't be a support zone again. I don't see anything on this chart right now that sets the market into an uptrend. They have layers of resistance at the 18-day average and the 100 under the current chart pattern. In terms of momentum, I've got a bit of divergence. What I have is the bias down, and I define bias as being up or down in its close to the 18-day average of closes, which is in red, not the 100-day in the green, that one. Momentum is pointing up, and I'm void of a trend as I define it. So I have a market that's sort of flipping back and forth right now. The meal market was fortunate enough today to rally strong. Let me just show you. You came in with lower highs, lower lows. Today's high just took out 311.60. It's enough to negate the downtrend. The market had given the bears a bit of an opportunity, as you can see, 3 days worth, to get out of their shorts. It rallied back to the 18-day average. Then on Friday, it continued to go up today even further before reversing back down. The market was not strong enough to get up to resistance of the upper Bollinger Band and the 100-day average of closes. Remember on Bollinger Bands, they're an algorithm, these black dashed lines. Think of it this way. The first time you get up to its resistance, the first time you get down to its support. And pros often look at those and they'll lift some positions when they get there. That's my theory. I'm not saying it's the typical theory of Bollinger Band, but it is certainly how I believe it works. In looking at the market, you're not yet overbought. You have a 66 reading. I define momentum over 70 as being overbought. So you still have upside momentum. You've taken out a previous high, but you're not in an uptrend. You negated the downtrend. Soybean oil, on the other hand, is bearish. Lower highs, lower lows. It stopped today at the green line, the 100-day average of closes. If it pushes through that, I look for the Bollinger Band to be a good support area in the market. Not a bullish area, an area that between right here, the 100-day average, and that, the pros are taking some money off the table. Then I look at momentum. Notice how both numbers are both numbers are under 20. They were under 20 on Friday, and they were under 20 on Thursday. not on Wednesday. So what that means is you have 3 days in a row. It converts the market from being oversold to locking in a bear trend until the red line gets back over 20. So on rallies in this market, I'm looking for those that want to be short, or the bears, if you'll call them that, to come out of the woods until that number is lost, still trying to press the market to somewhat lower levels. In the corn market, you went up today, fought a battle against the 18-day average of closes. That's the red line. You got there on Friday. Today you got there, couldn't get anything going, did not take out a previous high, just stopped right there. For those of you that are regular watchers, you know I call that the line in the sand. That's often the battleground in a market, and it's still acting like that today. Should the market not take out today's highs tomorrow, you would then have this as your new swing line high. So I'd move this number over here, and until that was taken out, I'd still say that the bears are in control of the market. But like we have in soybeans, there's a bit of divergence here. You have momentum pointing up because the market's under the 18-day average. You have a bias down and you have the trend down. I'll call it divergence. In the wheat market, tell me that this 18-day average doesn't come into play. Here you are, the 18-day average. The market loses an embedded reading. When that happens, often price and the 18-day average make a run at each other. I cannot tell you it's all the time because that would be wrong. Often is a lot. It's more than 50%. It's more than 60, 70 from my own studies. So I take a look to see if they're going to make a run. Here the market makes its run at it on Thursday, gets to it on Friday, fights a battle with it again today. That's what I call a run. If it gets that close to it, I'm happy. But generally what happens is you don't get price losing the embedded reading and prices going the other way down if it had been locked in bearish. That's really the point of this. And it's a warning signal that if one is short, be careful. You're probably due for a rally. Now, whether that hurts your longer-term picture shorter, that's up to you. In the sugar market, let's take a look at it again. Here is the market with the embedded reading. Here's the market losing it. You see the 22.12? You're back over 20. If I take you to the days before, you weren't. So that tells me the market's ready to make a run to the 18-day average. It certainly did it 2 days. Friday, this was the settlement. I'm looking at the market to get up there, and if it doesn't, let's come back this day. If it clears these numbers, the next resistance is the 100-day average. Now, if it clears that, wherever the Bollinger Band comes in tomorrow, that's the next resistance. What about on pullbacks? Because this is your resistance now to 1282, your support becomes 1260, and what you would not want to occur if you're a bull in this market is to take out 1226, because that would break the pattern of higher highs, higher lows. It would, at least intraday, put the market pretty solid under the 18-day average of closes. So that's what I think the bulls are looking at. In the coffee market, I think the bears are attempting to grab back control. They've had that rally off the lower Bollinger Band right in to the 18-day average of closes, that line in the sand. Today you have an outside day down. An outside day down with momentum starting to flatten out or turn down again with the bias down puts the bears in control. What's the number you wouldn't want to see hit? Probably getting through today's highs because it's an outside day down. It would lead potentially to a retest of the 18-day average of closes. Let's assume you want to press the market to the short side. What could be the downside target? I would say something near the lower Bollinger Band of 95.70. In the cocoa market, you have a market that had today another attempt at the 18-day average, failed again, came down, settled a tick lower on the day, and you've got a pattern of higher lows, higher highs, but under that number with momentum flat. This market's not trending. In the cotton market, this is a resistance zone. The upper Bollinger Band represents resistance. The market is overbought, hit upside targets right through here. It could work higher, and if it does, the 100-day average comes into play. Now the question is, will the 18-day average, which is 73.81, get above 74.02 so that on pullbacks you can see support without breaking a previous low? I can't answer if that's going to happen. What I can tell you is you're overbought, and I think pros are taking money off the table. In the cattle market, you had another spurt to the upside today. You finally cleared on Friday the upper Bollinger Band. The question now is this basic attempt at sideways action, if you look at the Bollinger Bands, going to have any follow through? And it's having it. That's a friendly sign, even though the market's overbought. Why? In order to come out of sideways action to the upside or downside, if it's to the upside, you are going to get overbought more times than not, or oversold. That doesn't mean the pros are going crazy here buying over Bollinger Bands, because you can generally do better than that. Not all the time. I'm going to show you a chart that proves that. In the feeder cattle, each time you've hit the upper Bollinger Band, I'll stay with what I teach, that is a resistance zone. You've been in an uptrend, you hit your target. I think pros came out of the market. Here's a difference in what we're talking about. This is the hog market in sideways action, higher high, lower low, momentum flat. The market comes up, hits the upper Bollinger Band. I will stay with what I teach. I still think the pros were coming out of positions there. If the market continues up, the 100-day average comes into play. There you are over it. Now, if you start spurting from here, then this area, you could almost measure the width to the top to the bottom, becomes an upside target. The market on, this was Tuesday of last week, works a bit higher. So now you're getting 2 days in a row, and now you're over the 100-day average. You are definitely overbought. It's a difficult game to guess. The market starts picking up momentum. Everybody short under this market now is caught. That's one of the ways to look at it. And can the market feed on that? It fed on it Friday. It tried today to break back under this band this morning, and by day's end, it just picked up and went limit bid again. That was Friday's. This is today's. Today's was not limit bid. It was up 127 points. It got up as high as 88, 87 and a half, another 100 from that, so it was up 227 points. I looked at it as having the embedded reading. This is 6 days in a row over the upper Bollinger Band. So let's discuss that for 1 second. Normally, in fact, almost all the time, I tell you, I count each consecutive day over the Bollinger Band to be one of those 5 percentage points of the time. Here are your 6. Okay? You can go 7. You're playing for the norms. You're not playing for this. If you're playing for that, go on your chart and tell me how many times you can catch it. We've got a situation here of African swine fever, and the question is there going to be big export business for it? What about the hog supplies? Where are they? So that's what's going on. You know, one of the things that we talk about, and it keeps you up if you're an ag trader, and we talk about the hogs. We have special reports today all out in it. We did it last week too. Is we offer you an opportunity to set up your streaming quotes in a couple of different ways and to view charts that are actually usable. I've watched, and I have, a lot of these different mobile apps, and a lot of them just aren't usable. I think ours really are. You can set up price alerts, so your phone's going to ring if a price is hit. You can use voice control. Bring me a chart on June lean hogs. Show me the weather maps. You can do all these different things. And the weather we show are for the farmers. It's not your local area. It's not intended to be. It's about dryness. It's about drought. It's about excessive wet. What's going on? You can change your quotes to any way you want. And yes, folks, this will read the quotes to you orally, in fact, if you're driving. So you can set it up different ways. There's another look that you can set up your quote screen with. It depends what you want it to do. The news, you're going to find it's commodity news. It's meant just for what it is. You're not going to get your Cubs score in it, okay? If you'd like to have a free trial to this, and we have them, the same one will work. You can set it up for your financial markets, your different types of markets. It's all the news the way you want it. Give us a call. You can go to our website, sign up for a free offer, and we'll put it right in there for you. I'm Ira. You have a good day.